Hello and welcome. You're watching The Money Show. I'm Kavita Thapliar, and this show is a one-stop destination for all your personal finance queries and your financial portfolio planning. And today on the show, we are going to talk about Trump tariff impact on your personal finance portfolio, on your investments. Also, we'll be answering your portfolio queries. Just in case you're watching the show live and want to send across any of your questions, you can do that on our WhatsApp number, which is 8657974571. We also have an email ID, themoneyshow@etnow.tv, where you can send across all your financial details and our experts will do your life financial planning. All right, so let's begin. US President Donald Trump made a major announcement imposing new tariffs of up to 27% on India along with the other 180 countries. Now, this move has sent shockwaves through global markets, raising concerns about its impact on trade, businesses and economic growth. Now, Trump's reciprocal tariff policy could pose short-term risk for Indian investors, especially those holding IT, pharma and auto stocks. Now, however, with a well-diversified strategy and focus on India's growing domestic economy, investors can navigate the uncertainty and find new opportunities as well. So in today's discussion, we break down Trump's latest tariff decision, its immediate and long-term effects on India, and how businesses and policy makers should prepare for the road ahead and India roles in the new world trade order. So you guys need to stay with us as we analyze this developing story with experts and industry leaders. I have with me Feroze Azeez, Deputy CEO Anand Rathiwell, Sunil Subramaniam, market expert. Good evening and welcome to the show. Sunil, my first question is for you. Throughout the day, we have discussed about the impact and probable outcomes, definitely. But I want to focus on with you is, do you see India and the US finding a middle ground now through diplomatic talks? How important is it for us to actually go ahead and do it, which you're also hearing in news that there have been rounds of, meetings held in New Delhi also. What, according to you, can be a roadmap for New Delhi to get in touch with the White House and, come to a middle ground?
So I think first thing, I would like to give 3 data points for you, okay? The first data point is 80, 13, 2.5, okay? What is this? $80,000 is the per capita income of US, $13,000 is the per capita income of China, and 2,500 roughly is the per capita income of India. So the whole reason this whole tariff thing has come up is because so many years the US has been buying from China because Chinese economy is far poorer, if you say from a per capita GDP perspective, than America. This is coming through because it translates into labor costs. And there I will tell you that the manufacturing labor costs per hour are 30, 4.2 and 1.6. That is $30 per hour in the US, it's $4.2 in China and 1.6 in India. So this differential cost is what has led to China exporting $770 billion to America, and the trade deficit is about 275 for America versus China, right? Now, as you saw from the data, India is much behind in terms of per capita GDP and much cheaper in terms of manufacturing labor cost. On top of this, going forward, if Trump is going to put the tariff and try to level this cost differential and try to make manufacturing in America, that's not going to happen in a hurry. So while he puts these tariffs, the core products are going to get costlier. Yes, the US coffers will get filled, but the products are ultimately going to get costly for the American consumer. So Mr. Trump himself has to find another way for a lower cost methodology to come through. Now, with the slightly lower tariffs on India, but with a significant cost advantage, right? India can be the new China for America. That's the basic premise around which this whole thing is based on. And for us, it's imperative because over the next 2 decades, China, because of its one family, one child policy, is losing about 11 crore people from their working age population. Whereas in the same period, India is adding 15 crore people. So being the second youngest country in the world, we have an imperative to provide jobs. So the reason why India is also eager to deal with America is because we can, over a medium term, substitute China with cheaper products. And from a perspective of the deal there, since we don't want to be in the same situation as China, in the future that, America, Trump-like person hates India and says, you're charging me too much, you're too, the point is we have to redress the trade surplus or the deficit, right? Our trade surplus is about 46 to $50 billion. China's is 275. But going forward, if I will take you back to Mr. Modi's visit to Trump's, in the US after his inauguration, where they jointly agreed that from a total trade volume of $170 billion, we will triple this to $500 $300 billion. So both the governments, both the heads of state are agreeing to work to grow the business. Now, naturally, that growth can't be that only India exports to America and doesn't buy anything from them. So the way forward is we have to buy significant things from America also without putting tariff. And two of those big items which are there in the anvil are oil, because India imports 83% of its energy requirement from outside, from either Saudi Arabia, Iran, Venezuela, Russia. So we will need and we will work towards that to switch that to American imported from America. So that's one big chunk of redressing the trade balance. The third one, next one will be defense related exports. America has already talked about F-35 planes that they can sell to India, but a whole bunch of advanced automation related, warfare related things from America, which are anyway going to be expensive because American labor is expensive, but they are high tech and so maybe worth it. So these two areas, if India can put on the table there, agree to reduce a bit of tariffs on the right. I think we have a trade deal. Both the teams are already in discussion. Significant parts of the talks have concluded. And by fall this year, August, September, a bilateral trade agreement is expected to be in place. And as we have seen now, US already Trump has exempted Mexico and Canada because under the USMCA, a deal has been signed, so he's not disturbed it. Similarly, when a bilateral trade agreement is signed between India and America, right, you will find that we will be outside of this tariff thing and we will have a separate deal. And that's the reason both governments are sincerely at the ground level working towards it. I think I've explained the logic of why they're working towards it, and I'm confident that it will succeed. It may take a few months here or there, but it will succeed. And out of this whole tariff jhamela, if I may call it, I think India can come out to be a winner in the medium term.
The statement that you made that India can be the new China for the US. Now, but then, Feroze, along with India, just like India, all of the nations would want to negotiate and would want to come on common grounds with the US, right? So now, in this particular scenario, could we see more protectionist policies coming up from US, making trade even tougher because there are so many other countries wanting to negotiate, okay? And maybe over there, Trump too can offer, a cut in the tariff rates also. Also, what scenario would you like to paint and help us understand tariff impact on India's GDP and growth and trade deficit in the coming quarters, Feroze?
Yes, Kavita. See, of course, like Sunil sir explained, the logic of why both these countries need to come to a mid ground. There's a compelling reason why India and US have to work together. I personally think this whole unsettlement of global trade is going to be immensely beneficial to India, like again Sunil Saab said. Why do I believe that is? Like US has a $320 billion export or a trade surplus with the US, not even just the export. You look at other countries, if you see Vietnam is $120 billion surplus. And then you have smaller countries also having very large surpluses. When you look at India, it's just a $50 billion surplus. Of course, 87% of all the goods we export are impacted by these tariffs. So it's practically everything is getting impacted. So it's going to have a short-term impact. But I personally think that if you look at India's positioning over a long period of time, because India is going to be the cheap source of manufacturing for the US, and I concur that it could be the second India, second China. India could be the China for the US over the next 10, 15, 20 years.
So, Sunil sir, now understanding one more aspect, could this policy push India to strengthen trade partnership with Europe and Asia? How can you explain this?
So I think that where we are not able to come to an agreement because the Indian government needs to negotiate with the domestic traders also, right? The exporters, and whether the tariff reduction with that they'll be sustainable. So wherever they are not able to, they don't want Indian industry to get hurt. I think they will try to divert that business into the European zone or the other zones, right? For example, defense. Trump is withdrawing support, armament support to Ukraine and to probably to NATO. And each European government on its own is now going to increase its defense expenditure. So possibly on the defense area, exports to the Europe side. So I think that India, I think, have released a statement now saying we are working closely both with the American government, but also with Indian companies here to understand the implication. There may be some cases where a tariff cut can't be done by India. So they will just cut it out of the US's picture and say, okay, there we accept your tariff. But those experts could then get diverted to other countries. So it will be very specific on a case by case because the government has a responsibility not only to build business with the US, but to take care of domestic industry also.
Right. So now, Feroze, now in this context, how about international investment scenario? How has that changed? China was just picking up, after a very lull period for almost 3 years, if we can say. Valuations were really reasonable, even it was attractive for FIIs. Now, again, there is a twist in the story. We talk about investing in emerging markets, even from a FII's point of view, from your HNI clients and from a retail investor point of view also. Which international market really looks stable, if at all one wants to diversify, or it's the time to just, stay away till the time we have all of these trade policy issues sorted?
See, the two kinds. One is an Indian investor investing abroad. The other is FII's interest in India because of its relative better positioning during this situation. Can that increase? Then coming to a mutual fund investor who wants to invest globally, should he use funds? Should he use a specific market? So, to my mind, I think the US market is something which has done significantly better than India, but the US GDP or the economy has not done as well as India has. The earnings growth of S&P 500 over the last 11 years, where it has outperformed Nifty, even in dollar terms and rupee terms, is somewhere where I think that the US market is a little stretched. It is stretched because it has become valuation agnostic. It has become valuation agnostic because 80% of the investments are index funds. Index fund investing is got nothing to do with valuation. It buys momentum, right? If the top stock does very well, its weight goes up. If its weight goes up, more money comes in. More money comes in means more price has gone up. More price gone up means more weightage. And this cycle is what has taken US significantly ahead than the global market. India is a valuation sensitive market. If you look at, not more than 10% of the money is index based domestic. So point I'm trying to make is, don't run towards US from an investment standpoint. I think that bus is missed. Point one. Point two, you can invest in other markets, of course, but not at premiums like they have been. I personally think using the LRS route for an HNI is more sensible because you're going to be more cherry picking than just using the mutual fund route. Then coming to FII's money into India, I am reasonably bullish. The kind of exits which we have seen, almost 3.8 lakh crores, which has gone out, I think it's the fag end of the exit. Of course, the foreign investors were considering India to be a very, very overvalued market. But if you look at the small cap 250's earnings growth, that has not been bad. That's been 13% expectation for this year. And the first 9 months have panned out reasonably well. Of course, 1 or 2 quarters have been bad. And if you remove outliers, especially those which have a 900 PE, those are technology businesses. If you remove them, at the mean and the median PEs are not so bad, even in the small cap space after the latest correction of this calendar year. So valuation seems now in the zone of almost intriguing FIIs back again to consider investing. So I'm reasonably positive the next 1 year, 2 years, FIIs come back in. And FIIs are so price insensitive. If they decide to buy something, they buy it irrespective of price. We did a study. Every unit of money invested by FII results in a larger price movement because they're a price inelastic group. Unlike a domestic fund manager, he is very specific. If he wants to buy this business, he's so price sensitive. I've had interactions with fund managers. They say they're positive on this stock at 100 rupees. At 120, they don't want to buy. So I'm reasonably positive that FIIs come back in, it'll be difficult to catch the market. And getting back to peaks isn't going to be so difficult if FIIs turn positive, which seems likely.
Sure. I think Sunil sir has a point because since the time we've started answering, he's been smiling. So I think that smile means that he has a point to add, Sunil sir.
No, I was just saying that, I've seen a lot of people put money into the US market, into NASDAQ stock, into the glorious seven. I think it's time for ghar wapasi.
Okay, that's interesting. Ghar wapasi, yeah. So, but then domestic facing investments, what should that be on your radar now?
So I think that for the short term, though the next 6 months, I would say stay away from international related sectors because there will be volatility. So banking and financial services and consumer discretionary would be my 2 picks because you have the 1 lakh crore of tax giveaway flowing through in this during the course of the year. Probably by Jan next year, you will have the new pay commission numbers come in. So that will give a boost. So I think overall the BFSI and consumer discretionary are going to benefit from this throwback. And I think the international scenario being very weak now, with inflation trending down, the case for RBI to do a good rate cut on April 9th is also there. And again, rate sensitives on both BFSI and consumer protection are rate sensitive. So I think it's a good time to put some money into those spaces because they will be less volatile. And then over the next 6 months, as a bilateral trade agreement comes through, then you can start looking at the international oriented sectors to see how they pan out and then add value, add your holdings there.
All right, so interesting takeaways from the discussion. First being India, the new China for the US, and for all the investors, as explained by Sunil sir and Feroze, it's time for Ghar Wapasi. Thank you so much for being on the show today, both of you, and helping our viewers navigate to these times. Thank you. All right, on that note, it's a small break on the Money Show as well. We'll skip into the break, and post that we'll get your portfolio queries answered by Anil Rego. Just in case you're watching the show live and want to get your financial strategies assessed by our experts, you can WhatsApp us your question on 865-797-4571. We also have an email ID, themoneyshow@etnow.tv. A quick break, and then let's connect with Anil Rego, our expert for today, and we'll be talking to our viewers as well.